welcome to Cigars and Taxes, another episode of Cigars and Taxes podcast. Thank you guys for joining us. Layton Smith here with Stacey Smith.
Hi, guys.
Hey, both shareholders of Hoffler Smith Financial Services, and we're here again today to have a wonderful smoke, have a drink, and have a good conversation about a tax topic. What are we talking about today, Stace?
We are talking about the tax benefits available for education expenses. I was about to say college students, but education expenses.
All right, it's going to be a short episode. So,
important information.
Yes, very much important information.
Not terribly lengthy, though.
So all that being said and done, we're going to get ready to jump into it. So we are breaking the rules today. We are having a good smoke, sitting here with the aroma de Cuba, and Stacey smoking a
Fat Bottom Betty.
But we're not drinking bourbon today, and
Or tequila.
Oh yeah, and the margaritas. Yeah. It's like 10 o'clock in the morning. I'm sorry, it's 11 o'clock. Yeah. So yeah, we don't start drinking this early. All the other episodes we've done.
Not unless we're in Jamaica.
This is true. This is true.
Then we get a pass, you know.
We were going to do episodes when we were in Jamaica.
We were.
It rained every afternoon that we were going to take these cameras out.
Disappointing.
Get set up. And it wasn't just a little sprinkle. I mean, it was a torrential. Boom. All right. A half a foot of water. It was just like, okay, I'm not going to lose all my equipment out here.
It's insane amount of rain. Oh my goodness.
And then by the time it stopped raining in the last few days, we didn't want to do no episodes.
No, we just wanted to enjoy the little bit of sun that we were going to have for the trip. So
that's it. But either way, we are drinking coffee, and you're drinking, what is that, tea? Is that coffee?
No, this is espresso.
Espresso? That's a big glass of espresso.
I know.
All right. Well.
It's morning still.
I know. So we got our coffee, our espresso, our cigars.
Yeah.
We're just going to act like it's Sunday morning. The only problem is the next half dozen episodes going to be in the morning.
Yeah.
So we ain't drinking. Oh, this is horrible.
That's all right.
Okay. You guys are going to have to skip the next 6 episodes. We're not going to be lit talking. All right, let's rock, baby. Let's rock.
All right. So today, again, we're talking about tax benefits that are available for education expenses. And really, we're looking at the main tax benefits. So a couple of deductions, credit, actually one deduction.
And two credits. 3 credits. You have the student loan interest deduction.
Yes.
3.
Yeah. So we'll just jump right in.
Let's do it.
Okay. So the credit that most people end up referring to, and I feel that it is, dare I say, the one you get the most back from in most cases is the American Opportunity Credit, previously called the Hope Credit. Hope Credit. It had evolved, changed, transformed, but it is now the American Opportunity Credit.
The actual credit is still the dang same. The credit, the amount of the American Entry Credit,
it's a little bit more. It's a little more.
So the whole credit is like 2,000.
I think it was something like that. I know it was. Okay. It was definitely better. You know,
it's like $500,
and it was expanded a little bit too.
All right. Mm-hmm. Not bad. Bad. So basically, this is the one of the big things with the whole credit you have to remember is it is only for 4 years. You get to claim it for 4 years.
4 years or your bachelor's degree, whichever comes first. So if you're one of those real smart folks that run through and get your bachelor's degree in 2 years or 3 years, that's it.
Or if you're slow as a donkey and you then took 7 years, you still get 4.
Oh.
Okay.
They call them, you know what they call them now? They call them, they say super seniors.
Our children was at home and they were talking about super seniors, and it was like, what the hell are you talking about?
So if you take more than 4 years, but you know what? If it takes 4 years, 5 years, 7 years, 10 years, if you get it, you get it. So we're not hating.
Yes, I'm not talking bad. It took me. I worked full time through college, and I was like a little over 5 years.
Yeah.
So
our son took almost. What was it? It's 4.5. So, So I mean,
I did not officially hit dumb as a donkey category because I didn't hit over 7.
The thing is, your issue was you were working full time the whole time.
Oh God, I remember that.
So that was the thing. And when we were able to do this, you stopped working that last 6 months, semester, year.
The last year I stopped working. But I worked full time at the IRS the whole time. And so you got to remember, give you a little background. So while I was in undergrad, she was in grad, a couple of years older. And she finished school, and I was, a youngin' still in school. And then I went past the 4 years, and her mama was looking at me the whole time like, I think you dumb as a donkey.
Oh, stop. Do you remember my parents cornered you at the house?
Yeah, when are you going to graduate?
Yes.
Oh, God. My problem was I was working full time at this ridiculous the trial revenue service. And I was attempting like an idiot to take, I think one semester I had like 18 credits, something crazy like that.
Every semester you did that.
And then I had to drop a class because I could not do all of those. Oh.
Yes.
Oh.
So,
anyway.
But you know what? You finished. You finished. You finished.
I think we're going to have to edit this episode.
No,
I'm going to get the label dumb as a donkey from this point forward.
No, you're not.
All right. Come on.
No,
let's jump on.
All right. So, okay. The amount that you can get for this credit is up to $2,500 per eligible student.
Yeah.
Okay. To be eligible, you have to be at least a full-time student in a degree or certificate program. And again, have not completed the first 4 years of this post-secondary education. All right. Now, the credit does phase out based on your income. So once you hit $180,000 for married filing joint,
or 90 if you're single,
90,000 if you're single or had a household. That's it.
Yeah, you don't qualify for the
credit.
Not going
to qualify it. Now the phase out starts a little bit lower than that, so you may not get the full $2,500. So
it begins at 80,000, right? And 80,000 for single, had a household, and like 160. Yeah, for married.
So you got a little window for that.
But if you're making 300,000 and you got 7 kids and they're all in school, you're not going to get this one. Yeah. The other thing to say talk about this credit, we jump to the next one. This is supposed to be a short episode.
Right.
Is that 2,500? It is splitting into two. There is a $1,000 that reduces your tax, and there is $1,500 that is refundable.
Yes.
So
I call it like a bonus credit at the end.
Yeah. So just think about what I just said. It's a $2,500 credit, but the first 1,000 of it reduces your tax.
$1,500.
Oh, it's $1,500 that reduces.
$1,500 and then $1,000.
$1,000 is refundable. Okay, I had it backwards. Okay, so it is split into two. So it's not a $2,500. You will receive flat out $2,500. If you do not have any taxable liability, that credit will be reduced. You will only have the refundable portion of that credit, not the piece that reduces the taxable liability.
Just as an example, we do see sometimes that there are students who are working, and they're working just enough so maybe they should claim the credit, maybe they shouldn't, and we're going through the options and seeing what they make. Oftentimes what we see is that if the parent claims it and they're working, I don't know,
let's just say they're making, let's just say if they're making $50,000, they will receive the full credit of $2,500. Whereas the kid who is working at the bookstore at the college that made $15,000 last year, they will not receive the full $2,500.
They typically will just receive the $1,000 refundable portion. They might receive some portion of the $1,500, but they don't usually see the full value
because they don't have the income.
Right.
Yes.
Right.
All right. And the last thing I'll say about this point, and we can jump, is in not recent years, recent years, probably the last 3, we have seen education audits pop up with this one in particular. And it actually hasn't really been an audit. It's just been the IRS has denied the credit because the individual claimed it more than 4 years. And there's really no fight there. All right. You claim this credit more than 4 years, or you did something odd like the years before, people were claiming a HOPE credit, and then they started claiming a lifetime learning credit. Still, that it was 4. for those two combined. And what the IRS would do is they would just remove the credit altogether.
Yes.
Then we would have to amend the return to take the lifetime,
The other credit.
the deduction instead of the credit.
Yes.
The IRS, in all of those instances, they did not just switch it
Oh,
from
no.
lifetime learning to, they did not switch it from the American Education Opportunity Credit to the lifetime learning.
No.
They just denied it, and then we had to amend those returns. So just
Exactly.
another thing to keep in mind. 4 years.
Right.
All right.
Typically, when the IRS decides to make a change to your return, it's not usually because they notice something else would help you instead. That's not what happens. Okay. It's usually because there's something else that they're going
You mean
to
they don't come in and say, you left some money on the table. Here you go.
That's what our job is to
Every
do.
now and then, if it's withholdings, you might see that. If they did something or math there, or they typed in something with the withholdings, the IRS will make the adjustment. Every now and then. Okay, all right.
Percentage of times that you see that.
It happened once or twice in my lifetime.
Did you say once or twice a month?
In my lifetime.
Oh. Okay.
In my lifetime.
There you go. So that's my point. All right. So we're talking now about the lifetime learning credit. That's the next one that we go to after we've exhausted the American Opportunity Credit.
After you use those 4 years.
Yes. After you use for 4 years, usually we're looking at the lifetime learning credit or the tuition and fees. So lifetime learning is very similar. It's offsetting, the credit is ideally supposed to offset tuition and fees related to post-secondary education to improve job skills. That's the official description.
Somebody did some research.
Hey, I tried now.
Here we go. Okay.
You can get up to $2,000 for this one as opposed to the $2,500. And unlike the American Opportunity Credit, lifetime learning is lifetime, unlimited number of years. So once you exhaust that, a lot of times we'll see people that are continuing in school, that's the credit we usually typically try to use.
As long as the income allows. You have a phase out of, there's a phase out of like 65?
Begins at 59,000 and completely phases out at 69,000.
69,000, okay.
Right. So that's for individuals. So for couples, we're looking at
138.
Yes, 138,000, and it starts at 118. So 118,000 to complete phase out at 138,000.
Sounds good.
All right.
Lifetime learning credit.
Lifetime learning credit.
You don't get in any trouble for that because you didn't claim it more than 4 years.
That's true. That's true. Okay. So, did you want to say anything else about that, or you're good?
No, you hit all the points. Lifetime learning. I mean,
okay.
Like I said, the big thing is the phase out limits. That's where we
That's the
hit
part
the wall.
that kind of stinks. Yeah.
Yeah. 138,000 is the phase out limit for a couple. And to be honest with you,
we see a lot of couples that
you phase out pretty quickly. Yeah, that's it.
Next up is tuition and fees deduction. Okay, this one works. It's slightly different in the way that it works, but the end result is that you do get something back for having education expenses. All right, so I'll just go into it. This one is actually interesting because this one was supposed to expire, and then they extended it to come back. And this was due to the Tax Cuts and Jobs Act that was part of that chopping block.
This one might be sunsetting in 2025.
We'll have to see. I mean, they've extended it. They've extended it. So
the basics is the maximum deduction here is $4,000.
$4,000.
That's the max. And the maximum deduction is $4,000, and it phases out at $160 for a couple, $80 for an individual.
Correct.
As opposed to $138 for a couple, $69 for the individual.
Right.
So sometimes what happens is we have folks. So let's just say you're single, and you made $75,000. You don't qualify for the lifetime learning credit anymore, but you can still take the tuition and fee deduction.
Correct.
Or as a couple, you have that wiggle room from that 138 to the 160. But once you go over 160, ain't none of these.
It's a wrap.
Yeah, it's a wrap. It's a wrap.
That's a wrap.
I'll be honest with you. These are so disappointing. We have 3 kids, and they're all the same age. They're literally all. So we have a 25, a 24, and a 23. I think that's their ages now. 25,
that is their
24.
ages. Right now, they are 22, 23, and 24. Taylor will be 25 in October.
All right.
Yes.
Yeah, I was close, guys. I was close. But
yes.
either way, all the time they were in school, that phase out.
Yeah, we didn't make it.
Oh my God, it's so painful.
Yeah.
Because we were one of those couples, we didn't put enough money into the 529 when they were young. So all the 529 money got like sucked up like a fat kid with a Slurpee.
Yeah.
And in the first like year and a half, and then we couldn't even get the little damn credits.
Right.
Man, it sucked. Because I was seeing everybody else with like 19 kids. And they were getting all this money back. They was getting all this bread back. It was crazy.
Listen, there's pluses and minuses to everything. So.
You will only hear Stacey say that.
No, I'm just
There's pluses and minuses to everything.
That's the truth.
I see no plus and no minus. Well, I see minuses, but I ain't see no pluses. I was so happy when those kids finished school. Oh my God.
Here, if we had 19 kids and we still fell under this income threshold, life would be hard on the boulevard. Okay.
Look, all I know
That's
is we
just
had to make all those tuition payments in. You see the shirt I'm wearing today, right? Oh snap, with the, prosthetic hair. Listen. Oh, for the people on the podcast, you can't understand. So I got a picture, a t-shirt on with a picture of a gingerbread man with his foot broken off.
And he looks to be in distress.
In distress.
Yes.
So all the time while the children were in college and we were paying these tuition and we couldn't get any of these credits, I was in distress. I was just like that. But I did have my foot back then.
Oh.
Okay. But
so
still,
this is a different interpretation of giving an arm and a leg.
Yeah, I lost a leg, yo. That's what happened. I lost a leg. So for everybody listening, I got this really cool t-shirt on with the gingerbread man with the missing foot. And I'm sitting here with my prosthetic out. So I can make jokes about this.
This is a whole
but other people
visual.
can't, though.
This is
Other
a
people
whole
can't.
visual. No. Mm-hmm. Yeah.
All right. Let's rock.
All right. So we've covered so far American Opportunity Credit, Lifetime Learning Credit, and tuition and fees deduction.
Those are the three.
Those are the three. A couple other things that we're going to hit is student loan interest deduction.
Oh,
now that's for after you finish school and now it's time to start making payment on your student loan. If you took out a student loan, education loan, and now you're making those payments at this point to pay it back, you can get a deduction for the interest portion of those payments.
Maximum of $2,500.
$2,500 is the maximum. So
still $170,000 phase out for couples, and
yes, 70. It begins at 70 to 85 for single.
Yeah.
Yes.
And phases out 170 for couples.
Correct.
So the same thing. If you're a couple, you have over 170 in taxable income. Yeah, you don't get this credit either.
Now, there are certain circumstances where your student loan might be forgiven, like outside of just taxes, but maybe you've put in a certain amount of service or type of service.
You mean working at a nonprofit?
Yes, things like that.
So you're talking about getting loans forgiven now?
Yes. So I'm just mentioning that because many times we have people that come in and say, oh, I got this loan forgiven. Do I have to report it? That is, I would say that's a case-by-case basis, but most of the time it's not. It's,
right.
It's
not federally, but it depends on the state you're in. So there's certain states that if your student loan is forgiven, they still tax you on that forgivable piece.
Yeah.
But I think there's only like 4 or 5 states. So didn't we do a show on this already? An episode on this?
We mentioned it, but so it is one of those things that you would want to check on. So if you are in that situation, definitely check with your tax professional, and see what the rule is for your state, and just to make sure you're on the same page.
Sounds good.
Okay, so that's student loan interest. So the only other things I have are the savings plans. That's our next segment.
Saving plans, okay.
Yeah. So I'm just gonna mention them. There are.
You talking about like the 529?
Yes.
Okay.
529 Coverdale. So there are savings plans that you can invest in for your children. So that basically you're saving for college before it's time for college.
Look at that big smile on her face as she talks through this.
I like planning. This is the thing.
This is a thing we didn't do too well.
No,
well, we thought we were doing something when we were putting money in the 529 account for the kids.
Whatever we did was better than if we didn't do it.
That is true.
So
you got certain states where there's a 529 phase out. Like you can only have about 200 grand in there, or 220.
There are limitations.
There are limitations. Mm-hmm. And, I just lost my thought. I was thinking, the limitations to the 529 plans. Oh, this is what I wanted to say. Oh, it's crazy, y'all. It's crazy. So our kids.
Here we go. Here we go.
They're really smart.
We'll have to tell them to watch and listen to this one.
I know. They're really smart, but they're not that like top 5% smart. Like they're smart enough to get into a really good school, but they're not smart enough to get a full run.
Yeah, full scholarship.
Oh my God. I swear. So like I said, they're bright enough to get into a good school, not bright enough to get the full run. We didn't put enough money. We could never put enough money in a 529 plan I guess we could have possibly, depending, to take care of everything. So big thing, let's talk about the 529. I'm going to stop talking about my kids. This is painful. But with the 529s, you do have that limitation of, depending on the state, how much you could put into the plan.
Right.
The interest that grows on a plan is not taxable as long as it's being used for educational purposes.
As long as it's using for tuition, fees, books, room, board.
Right. So
they're qualified. There's qualified expenses. So those count as qualified expenses.
So if you put
car payment for your kid does not count.
True. So if you put money in a 529 account and your kid piss you off and say they ain't going to school, and you're like, well, look, you got 1 year to use this, or I'm buying my boat.
Right.
Just understand it. When you pull that money out and go ahead and buy the boat,
taxable.
Taxable. The interest.
Taxable.
Interest. Taxable. Yeah. Yes. Is there a penalty?
I don't.
No. No penalty.
I don't think there's a penalty.
It's just taxable.
But it is taxable, which is typically enough.
There you go. That's it. Well, so it's on the interest.
Yeah.
But then you have your boat.
Then you have your boat.
I never got my boat. Oh, boy.
But your kids went to school and finished.
Yeah, I was told that after my kids finished, I can get my boat. I
okay, well, you can. Just not right after. You just told everybody they were 20-something. Early 20s.
Listen,
like the oldest is not 25 yet.
This is very personal to me, and I'm going through something right now.
Clearly.
All right, what's the next
All right, next one is the Coverdell Education Savings Fund. So people call it the ESA. Mm-hmm. It's another tax advantage account for education savings.
I'm not as familiar with that one. I don't have many clients who've used that. I have
don't either.
But I don't have much there.
Right. Maximum contribution is $2,000 per beneficiary per year.
Okay.
And in terms of contribution phase out, completely phased out at $220,000 for couples.
Okay, so similar to the 529.
Yes.
Is that state by state or is that a federal?
That is federal.
Okay.
That is federal. Mm-hmm. So, but the earnings growth tax-free, withdrawals are tax-free. So it's similar rules in that regard. So.
Okay, so the big difference there is there's not a lot of difference between that Coverdell and the 529. It's just that phase-out limit is a federal limit on the Coverdell. But the 529s, that's a state-by-state phase-out limit. It seems that the states handle the 529 differently. Got it. Okay, perfect. I just was trying to draw the line of difference.
Right.
Piece between the two. Okay, perfect. What do we got next?
Only other thing that I was going to mention is sometimes there's some benefits that you might have from your employer. Oftentimes, and these aren't tax per se, but more that they offer education assistance.
Okay, yeah.
You know, a lot of times the bigger companies will offer something like that.
I was about to say, who still does that? Coke, Apple? Folks like those.
People work there and they get it.
I did work. The state, maybe?
Certainly. Hey, the universities themselves.
That is true. Mm-hmm. You know, that was one of those points. You know, we had friends that worked at universities.
And that was the whole purpose.
Yes, they got their kids in there for like a quarter of the tuition.
Or free tuition.
Insane.
Depending. Mm-hmm.
Yeah, one of us should have got a job at a university.
Yeah, man, we'd have to take a decent pay cut. I didn't want to do that.
Okay.
What? That's the challenge.
All right, now you got to run the numbers now.
Okay.
How much will we save by not having to pay out of pocket for the education versus the decrease in income over those years?
That's true.
Now we're talking planning here.
Now we're talking
planning.
Yes. Well,
listen, we should have did them kids the way my grandmama did me. She was like, you 17 and a half, you almost 18. I took care of you this long. Have a good life. That's how she ran that. The rest is on you, cuz.
Oh, man. Yeah. Anyway.
I know. I couldn't treat my kids the way that was.
Well.
Not that there's anything wrong with it. No.
So I had one frequently asked question.
Oh, you got FAQ on this section already?
I did. And that question is about retirement withdrawals to pay tuition costs, because some people use that as an option.
Okay. So what was the actual question?
The question was, what if I wanted to use my retirement income and take a disbursement?
For education?
For education.
Well, they're not penalized. Education is one of the exceptions for withdrawing from your retirement account. Mm-hmm. So there's no penalty.
Right.
And it's pre-taxed money that actually doesn't matter, pre or post.
You're not penalized, but it is additional income. Mm-hmm. Yeah, it is additional income. Yeah. So honestly, I would look at maybe considering a loan from your retirement account as opposed to a full disbursement. But I guess it would depend on how much the tuition payment is that you're looking to make.
Oh, that's actually funky what you just did there. I like that.
Yeah, I don't know that I would do it for the entire. I'm just thinking. Oftentimes, what are we talking? 25 to 50,000 a year. Yeah. That would be a lot to pull out of your retirement.
Let's just say you're
lower expense.
Yeah, but you're talking about planning now, so this is cool. Let's just pivot just a little bit. Finish this up. So let's just say you're very close to being at the top of one of the brackets. You could pull out enough income from your retirement so you don't change your tax bracket. Okay, in the current year. So let's just say they start school in September. Mm-hmm. You can pull out 10, 15, but stay within that tax bracket.
Oh, so splice it out.
And then the rest you take out the next year. Still try to stay within the same tax bracket.
Right.
Yeah, that's good.
Only thing is, so I think it's worth mentioning that 10% penalty, that exception on that, it doesn't count for 401ks. It's only IRAs. Okay, so most employers offer a 401k. So typically the employees will, if they're full-time or been there for a while, they may have that type of plan. It would need to be from an IRA in order to have that 10% exception. Okay.
Sounds good.
All right. So I think that is all I have. I think so. Let me just make sure I'm looking at my little notes.
I think that's it. I don't know that there's anything else that's sitting out there.
Nope.
Or you're just going to jump into planning?
No. That's not what this episode is for.
I got you.
Just a couple little tidbits. So I'm hoping that you this was helpful, and that just shed some light on some of the credits and deductions that are out there. You can use this to assist you in terms of how you may want to plan to attack either your tax return or upcoming college expenses. So
that's it. Thank you guys once again for spending another episode with us. I know this was a short episode. Hopefully it was informative. And as we said, please, our show is meant to be educational and fun. Please talk to your tax accountant, your EA, your CPA about all the different deductions and credits that we talked about here to make sure whichever ones you're looking at, they actually apply to you. Talk to your financial professional.
Yes.
That's it.
And we're going to ask you, of course, if you have a question, have a comment, please reach out to us at info@cigarsandtaxes.com, or you can hopefully comment, like, subscribe. Let us know that whatever you're thinking about the show. Also, if this information might be helpful to somebody that you know, definitely forward it along.
Share the show.
Share
the show.
Thanks.
All right. Thanks, guys. We'll see you next time.
Attention students and parents. Is the idea of college expenses causing you stress? We are about to go through all of the credits and deductions that are available for you on your tax return. All right, we're going to talk about students, parents, lifelong learners, and how different things might be available from deductions, credits, and potentially savings plans. So if this seems like this would help you, stay tuned.
Yes, and we're also going to discuss everything we did not do right with our 3 kids and the pain that it caused.
Yeah, there is that.